Good morning, I'm Chad Justice, and welcome to Market Monday for April 27, 2026. The S&P 500 is in the 7,000s, and first quarter earnings are tracking ahead of expectations on both revenue and on profit. Oil is near $100. One of Iran's lead negotiators was forced out of talks. The Fed is still on hold with inflation forecasts close to 4%. The market is at a high, and a reasonable person could read the headlines and conclude that the economy is in a difficult spot. Both of those statements are true at the same time, and that's what we want to talk about today. Markets trade on expectations, where the economy runs on what's happening right now. Those two things aren't the same, and they are rarely in sync. What we're seeing isn't irrational. It's the market doing what the market does. And the market is looking past the current noise to where earnings, rates, and growth are heading over the next few years. And the fundamentals are cooperating. Earnings season has started, and initial results are coming in strong. 5 of the Magnificent 7 report this week, and the bar has been set higher by the results already on the tape. Corporate America is delivering. The headlines just haven't caught up yet. And the disconnect between markets and reality isn't a bug, but it's a feature. Look back at 1982. The S&P 500 bottomed in August while unemployment was climbing towards nearly 11%, the highest of the post-war era. And the recession wasn't officially declared over until 3 months after the market low. Nothing about the economy felt good that summer. The market moved anyway. Look back at 2016, a Chinese growth scare, a collapse in oil prices, and a Brexit vote that had investors convinced that a recession was imminent. The S&P 500 finished the year up 12%. Look back at 2023. A regional banking crisis in March had people convinced that the financial system was breaking. The S&P 500 finished that year up over 20%. In each of those cases, the people waiting for things to feel good before investing, they waited too long. Here's the part that trips people up. Your instinct is to want the market to reflect the world you see. And when oil is high, talks are fragile, and inflation is sticky. The market being at all-time highs can feel wrong. That feeling isn't data. It's discomfort with uncertainty. The market doesn't trade on present data. It prices future data. And investors who trade their portfolios based on gut feeling about the headlines usually end up selling at the bottom and buying at the top. This is why we build portfolios designed to stay invested through moments exactly like this. Not because we know that the market is right, and not because we think that the risks have disappeared. We build them this way because being in the market when the headlines are confusing, disciplined long-term investors get paid. Here's our ask. If you've been watching this market climb and feeling like you're missing something, you're not. You're feeling the gap between what the market is pricing and what the headlines are describing. That gap is really uncomfortable, and it's where most of the long-term returns get made. If you want to talk through what this means for your portfolio, this is a really good week to put something on the calendar. And if you know someone else stuck in the same place, forward this video their way. That's all we have for you today. As always, thank you for watching this week's edition of Market Monday, and join us again next Monday for more of the insights that matter to your money.